In this video, we're going to tackle the very important Modigliani and Miller capital structure propositions, something that you need to know quite well. Right, let's get to it. Well, under certain very limiting assumptions, I'm going to list those assumptions, but first I'm going to say what is true if these assumptions do indeed hold. The choice of a firm's capital structure, namely its actual mix of debt and equity that it chooses to use. So that choice of capital structure is going to be irrelevant for company value. Okay, so this is sort of the outcome, but let me tell you what those limiting assumptions are. First of all, well, the first one isn't that limiting, but it's the assumption of homogeneous expectations, meaning, you know, when investors look at an investment opportunity, they see the same sort of expected cash flows and value things in the same way. The second, I think, is more problematic, the assumption of perfect capital markets. And that means, for example, no taxes, which we know is typically not true in most countries, no transaction costs, but also no costs of bankruptcy or financial distress, no bankruptcy costs. It doesn't mean that a company can't go bankrupt, but this doesn't entail any sort of frictions, any costs. Now, later on, well, we're going to follow the sort of the logic of the Modigliani Miller propositions, and we will be introducing these imperfections. So, for example, we will have income taxes, corporate income tax. We will have bankruptcy costs as well, but not at the very beginning. At the very beginning, we pretend that these things don't exist. What else? The idea that investors can, even individual investors can both borrow and lend at the same risk-free rate. There are no agency costs. This means that managers, agents act in the best interest of shareholders to sort of create shareholder wealth, which is not always perfectly true. And financing decisions, i.e. decisions on how to fund a company or how to fund an investment, and the actual investment decisions, what to put the money to. Financing decisions and investment decisions are made independently, are taken independently of one another. Now, these are the sort of starting, somewhat limiting assumptions, but the idea is, if this is true, the choice of capital structure should be irrelevant for company value, because company value should simply be a result, or should be a function of the present value of expected future cash flows. So, cash flows are important. They're expected, or their PV. Obviously, when doing present value computations, we need to discount stuff. So discounted using the relevant weighted average cost of capital. And the big takeaway from here, which I want to write down, is that managers should not be able or cannot change company value or try to influence it by modifying the company's capital structure, For example, issuing more bonds and repurchasing with that borrowed money shares in the market, which we know they do. So the Modigliani and Miller, I'm writing MM just to save space, but these are very important surnames in finance. Modigliani and Miller, Nobel Prize laureates in economics. The so-called Modigliani Miller proposition number 1, in a world without taxes, is pretty much what we already sort of wrote down. However, I want to show you an argument that should be, well, until now I've basically said what the proposition implies, but I want you to appreciate where this logic comes from. Why should capital structure or the company's capital structure be irrelevant? It's because Modigliani and Miller argue that investors themselves are able to create any capital structure they want at their own individual level, are able to create or generate, manufacture any capital structure they want. After all, investors, and remember, one of the assumptions we made is that investors can easily borrow money and lend it at the risk-free rate of return. So if investors have access to risk-free borrowing and they want to invest in a company that, in their opinion, doesn't have enough leverage of its own on the balance sheet, that's not a problem. They can leverage their own transactions, so they can borrow adequate money to buy the shares of the company on the margin or using leverage, and in that way, sort of, you get what's known as homemade leverage happening, and that homemade leverage argument, remember, is only going to hold if you assume, or if you remember about the assumption that investors can easily, can borrow at the risk-free rate of interest. In that case, yes, it really does become actually irrelevant whether the company is levered or whether the investors do that themselves. So it shouldn't matter for company value what amount of debt a company has on its balance sheet. The conclusion from this first proposition, or proposition number 1, without taxes, is that the value of an unlevered company should be the same as the value of a levered one or a leveraged one. And as we already said, company value is just simply determined solely only by expected future cash flows. Expected future cash flows. And in a world with no taxes, because that's what we assume, right? No corporate tax, weighted average cost of capital is not affected by capital structure. That is proposition number 1. It's very limiting in terms of the assumptions, and we kind of probably do not instinctively agree with it, because we know WACC is not the same, weighted average cost of capital, irrespective of capital structure. There are going to be differences. So here comes Modigliani and Miller proposition number 2. Still, in a world without taxes, without taxes. Okay, let me highlight this. Well, I take this idea that WACC is not affected by capital structure to be a bit fictitious. I mean, I don't buy that, right? We know, we've been learning this, we learned this across the CFA curriculum, that the rate of return required by holders of debt, so effectively the cost of debt is lower than the cost of equity. And it's, even without taxation present, which makes debt even cheaper because of the tax shield effect, this relationship should hold simply by virtue of the fact that debt holders face less risk. their investment is less risky than that made by the shareholders. Debt holders, after all, have a priority claim on the company's asset, and they rank higher in case of liquidation than equity holders. So, debt is cheaper than equity, and we know that. So, as a result, if you increase the portion of debt in a company's financing, obviously in relation to its equity, debt being the cheaper source of funding, that should cause the weighted average cost of capital to go down, right? I mean, that's what we learn. Well, Modigliani and Miller's answer to this under proposition number 2 without taxes is, let's pose this as a question, right? This should be the case. Well, Modigliani and Miller say, no, that's not the case, but although the argument is logical, WACC doesn't decrease. Why? Because as you increase the amount of debt, which is cheaper, yes, that's right, the cheaper source of funding, you also increase the riskiness of the company because you increase the level of leverage in it. Debt has to be, debt has to be serviced, debt has to be repaid, and obviously you increase the risk that something will happen operationally in the business, its performance will be not good enough, and not good enough to service all that debt which is outstanding. So because you increase the level of risk in the business, you also increase the probability of bankruptcy, and that affects the cost of equity, or equity, the rate of return required by shareholders. As the company becomes more geared or more levered, the cost of equity, so the rate of return demanded by shareholders, just goes up because it becomes they rank at the very bottom of the hierarchy. So for them, this becomes a much more risky, increasingly risky venture. So what you get is perfect offset, at least according to Modigliani and Miller. You increase the proportion of the cheaper debt, but the cost of equity rises sort of proportionately, and there is an offset, which ultimately means that the WACC stays constant. It doesn't change. Now, okay, let me show you how this may be actually tested numerically, because under Modigliani and Miller's proposition number 2, there is also a formula which I think may be easily tested for the cost of equity, or the rate of return required on equity. So RE is the cost of equity, or equivalently the rate of return required by shareholders, but the two things are synonymous. And this is equal to R0, that's the cost of capital if the company is financed by equity only, is financed by equity only. Obviously, it's the cost of equity financing because that's the only one under this case. Okay, plus the difference between R0 minus RD of course being the cost of debt, and multiplied by the proportions of debt to equity. Be careful, because whenever you have these ratios, they always are based on market values. Okay, just be careful about this. So let me give you an example of how this formula would work. Let's say you've got R0 5%. So this would be the cost of funding for a company, cost of capital, if it was financed by equity only. Now, let's make the cost of debt equal to, say, 3%, obviously lower than the cost of pure equity funding. And let's assume that the proportions of debt and equity are such that D equals 1, let's say 1 million market value, and equity equals 9, so 1 to 9, right? Just to keep things simple. Now, applying the formula which I just wrote down on the left-hand side would give cost of equity for a company with this type of capital structure, R0, I said 5% plus, in bracket, 5% minus 3 multiplied by D over E, so that's 1 over 9, right? Nice and simple. Now, I'm not recording my calculator in this video. In fact, I even forgot to take it out, but I'm just going to now quickly do this computation. I'm sure you can do it perfectly fine on your own. So you've got 5% plus what in the bracket is effectively 2 multiplied by 1 over 9, so 2 divided by 9. To be honest, 2 divided by 9 plus 5. Okay, the answer comes in at 5.22 period sort of percent, right? Okay. What would therefore be the company's weighted average cost of capital, the WACC? Now, let me stress, there is no income tax, at least at this point yet, at this stage of the argumentation. So we're not going to kind of incorporate any tax shield effect into this discussion. The weighted average cost of capital will take the proportion of debt, that's 1, but to the overall amount of capital, so that's debt and equity, which is 1 plus 9, that's 10. Let's multiply that by the cost of debt, which is 3%, no tax shield, plus, now for the proportion of equity in the mix, equity is 9, the overall amount of capital is 10, so 9 over 10 multiplied by the cost of equity, which is the value that we just computed, 5.222%. And let's see what that would give. So I've got 3% times 1 over 10, so effectively divided by 10, plus 9 over 10 times 5.22222, you know, as many 2's as you can get. And I see an answer which is almost perfectly, well, it's 4.99999, etc. It's 5%, right? More or less. Okay. Let's see what would happen if we change the proportions. Let's say that now, instead of having 1 million of debt and 9 million of equity, we make things more equal. So what if debt was 5 million and the value of equity was 5? So we've still got a total capital value of 10. It's just that the split is now going to be different. So let's calculate the cost of equity in this situation, still using that same formula which we had up here. So we need to start with R0, the cost of capital if the company was financed by equity purely, 5%, plus the difference between that 5% and the cost of the debt, which stands at 3%, multiplied by the relation of debt to equity. So in this case it's 5 over 5, isn't it? Which basically gives 1. So we have 5 plus 5 minus 3, 5 plus 2, that gives 7%. Of course, the cost of equity has gone up as we put more debt into the capital mix. This causes the cost of equity to go up under Modigliani and Miller's proposition number 2. What will happen to the WACC? On the one hand, we've got more of the cheaper debt, but the cost of equity has gone up as well. So let's compute the WACC. Well, the proportions are as follows. The amount of debt in the mix is 5 over 10, 10 being the total value of all the capital, debt and equity, multiplied by its cost, which is 3%, and the same thing for equity, which is also equal to 5, the proportion of it in the capital mix is 5 over 10, and the cost of equity is this 7% we just computed. So we effectively have half of 3%, which is 1.5, and half of 7, which is 3.5. Well, that once again gives a perfect 5%. So what you could say is that the cost of equity in this under this approach, under the MM proposition number 2 without taxes, is that the cost of equity is a linear function of the debt to equity ratio. As that goes up, so does the cost of equity, in a way that offsets all the gains that would, naturally arise or that come from using the cheaper source of funding. The key takeaways or the conclusions here, and your curriculum also does this kind of stop after each of the propositions to put down some important takeaways. Higher levels of leverage, so higher proportions of debt to equity, cause the cost of equity to go up, but have no effect on company value, because they don't have any effect on WACC. Because company value derives from the PV, the present value of future cash flows, which get discounted using the WACC. If you're not affecting the WACC by your choice of capital structure, you're also not affecting the PV of those future cash flows. Hence, you don't have any impact on company value. As we increase the amount of debt, which, remember, is the cheaper source of funding. Nobody is, denying that this is the case. Well, the benefits of this cheaper source of funding are going to be perfectly offset by the increase in the cost of equity. So this is the logical conclusion of Modigliani and Miller's proposition number 2. And now we move to Modigliani and Miller proposition. Well, you may be expecting number 3, but it's not number 3, it's number 2, but in a world with taxation, with taxes. And we're specifically employing, corporate taxes here. So we know that in the majority of tax jurisdictions around the world, at least, debt is going to be, or interest on debt, not the debt is itself, but the interest on debt is tax deductible. So it creates an effect commonly known as the tax shield, which is beneficial. And here, under proposition number 2, with taxes, Modigliani and Miller say that indeed the value of a company which uses leverage, a levered one, is equal to the value of an unlevered company plus, so this is U, unlevered, plus TD. T is, of course, the marginal tax rate. D is the value of the debt, so this is supposed to be the present value of the tax shield benefits, the tax shield effect. So the point is, the increase that we get in company value, the fact that VL is higher than VU, increase in company value of a company that's levered, of course, is due purely or solely to the tax shield benefit. It's not because of the let's say, it's not due to any other effect, it's just due to the fact that we have the tax shield benefit. So, the conclusion is as follows. In the presence of taxes, taxation, let's say, a profitable company, and it's important that this is a profitable company, because if it's not profitable, it will have a problem to generate benefits due to tax deductibility of interest. Because if you're making a loss, you can't, and you wouldn't pay tax anyway. Just the simple fact that you're paying interest, which is tax deductible, doesn't decrease your tax bill any more than what you've already decreased it to, which was 0. But if you are a profitable company, such a company can increase its value absolutely by taking on more debt. Right? That's the sort of idea. And also, the higher the tax rate in a jurisdiction, the greater becomes the benefit of using the debt due to the tax shield. Right? What we therefore have also as a sort of consequence is a revised formula for the cost of equity, for RE, because previously we said it was R0, the cost of funding for a company that would be purely financed by equity. To this we added the difference between R0 and the cost of debt, and then I proceeded to multiply this by the ratio of debt to equity. Well, now we've got an extra term over here, 1 minus t, and only then do we do d divided by e. So as you can see, this, if the tax rate is anything lower, anything higher than 0, of course, if the tax rate is non-zero, is the fundamental change to the formula, which before didn't have this term. So you could think, we had 1 somewhere there. This will make the cost of equity lower, simply. Now, your book contains a very nice illustration of this, which I'm also going to draw, so replicate here. If this is the ratio of debt to equity, and over here you've got the cost of equity, let's draw some arbitrary level which I'm going to label as R0. Now, in a world without taxes, we said that the cost of equity, well, I even wrote it down, right, somewhere here, that the cost of equity is a linear function of the d over e ratio. So this is what I'm drawing over here. Cost of equity going up, being equal to what we originally wrote in a world, this was in a world without taxes. Now, in a world where taxes are present, this line is still upward sloping, but the slope is less steep. So here you've got the same thing, but with that extra term which reduces the steepness of the line, that 1 minus t times d over e. So this is the one with taxes, and because the cost of equity changes, of course, because the cost of equity is going to change, but in a way which now doesn't perfectly offset the gains that you get from using more debt. So let me rephrase this. If you're using more debt, you obviously are using more of the cheaper source of funding, which has with it the tax shield benefit. Your cost of equity doesn't increase as much as before to perfectly offset the gains from the cheaper debt. So now WACC is not going to be constant like it was before. Remember, we did that computation where we proved that the weighted average cost of capital would stay at 5% irrespective of the capital structure we had. Now, the increases to the cost of equity are not as big as before. So as the debt to equity ratio increases, the weighted average cost of capital actually goes down. And that is, that is a very, very important and powerful message. So the takeaway or the conclusion from this, or the conclusions, are going to be as follows. As the debt to equity ratio increases, the cost of equity also goes up, but the pace of that increase is slower than before, but at a slower pace than in a world without taxes. And obviously the slower pace that we talk about here is evidenced by this slope being, this angle or this slope being smaller than with the blue line that I also have up there on the graph. Another takeaway, so to speak, is that as the debt to equity ratio increases, WACC becomes smaller. This is what I just wrote a moment ago, but I didn't write that with lower WACC, company value increases, right? Because we're still sort of hooked on the idea that company value is a function of expected future cash flows that we think the company will generate. But obviously those future cash flows need to be discounted to their present value using the WACC. And as this WACC becomes smaller, lower, the PV goes up. And in the absence of any so-called costs of financial distress costs, including the costs of bankruptcy, and we'll talk about these in just a moment. The above conclusions could lead us to a somewhat extreme takeaway or logical conclusion. If you push things to the limit, well, what's the optimal structure then? What's the optimal capital structure? It should surely be 100% debt, which seems rather extreme. And this is where we leave the Modigliani propositions. And in the next video, we'll talk about some extensions of that framework. You see, Modigliani and Miller never said we should have 100% debt. This was more of a sort of logical thought experiment to make incremental changes one at a time. And in the next video, we'll extend the framework to include the costs of financial distress. I told you, we would slowly, step by step, be getting rid of those limiting assumptions that are there, like no taxes. Well, now we've stopped at there being no costs of financial distress. Let me tell you just, in this video still, what those costs of financial distress actually are, because you may be tested on what that term really or actually means. Financial distress is not just bankruptcy, liquidation, right? It's the increased uncertainty regarding the company's ability to meet obligations. So as a company possibly gets into more and more into trouble, so financial distress, even before it eventually goes bankrupt, if that is indeed ever the case, it may start feeling certain costs of being in trouble, of being in distress, like the loss of, good customers who are afraid to do business with you, or the loss of suppliers who also don't want to have anything to do with you. Maybe key employees start walking away. Creditors start pulling back and stop extending you credit. Now, ultimately, these costs may be of a direct nature, so direct costs of financial distress. So once you do indeed get into a situation of bankruptcy, right, there will be various bankruptcy expenses. Like legal fees, administrative fees that you'll have to, pay, expenses or fees. But there are also these indirect costs of financial distress, and they include things like, loss of business. There are the less tangible costs, loss of investment opportunities, or perhaps loss of reputation, so reputational risk, things like that. And those will need to be considered, because as you pile on more debt, the costs of financial distress really go up. So that uncertainty whether a company will be able to meet its payments. And in the next video, you'll see how that actually prevents companies from going 100% debt in their capital structures. For now, let's just conclude that these costs are going to be definitely lower if a secondary, so this is secondary, market exists for the company's assets. Think about, if a company is full of vehicles, machinery, buildings, those things can easily be sold in case and, satisfy creditors, etc., lowering the cost of financial distress. But so those companies will typically be able to pile on more debt without necessarily causing those costs to go up, to increase too heavily. But there are industries where the above is not true. And therefore the cost of financial distress are higher, preventing those companies from taking on too much debt. Especially companies in the technology sector, software companies, pharmaceutical companies, service companies, service sector businesses. They typically have much less of a tangible asset base, less tangible assets, and therefore the cost or the uncertainty with them being able to meet payments and what will happen to creditors is bigger. So the costs of financial distress are bigger as well.